Good or bad? That's the subject of today's video. What we're going to do is, in the context of hedge funds deleveraging, which sounds like a bad thing, we're going to take a look at what leverage actually is, how people get into debt, the other word for leverage being gearing or indebtedness, and how investors can use that to their advantage. We'll take a look at property, we'll take a look at investment trusts, a favourite of MoneyWeek, and we'll take a quick look at a spread bet on gold. So, three areas where leverage can work to your advantage, but be warned. The idea of hedge funds deleveraging, that's panicking and selling assets and trying to pay off debt, suggests that it can all backfire too. So, let's call it three ways that leverage can boost or seriously destroy your wealth. So, as long as you know what you're doing with leverage, it can work to your advantage, but be careful. Plenty of people who are in debt would regret that decision right now. Okay, so let's get straight in there. As a property investor, for example, or just buying your own home, is leverage a good thing? Now, a lot of people have to take out a mortgage because they've got no choice. But if you had a choice between putting down a big deposit and taking out a big mortgage, is there a straight answer as to which works best? And the answer is no, actually. All depends. In a bull market, leverage is fantastic. It enhances, accelerates returns, it's like magic. But in a bear market, when prices are falling, it's your worst enemy, or can be. So let's take a quick look. Now, I'm going to keep the numbers very simple here. So let's imagine we're looking to buy a house, just to get the basic example out here. And by the way, it is amazing how many people in financial markets do not really understand leverage. So it's one of those concepts that you really need to get your head around, I think, if you're going to play with debt. So you're looking to buy a house. Now let's say there are two of you, really boring, I'm going to call them A and B, both looking at houses, identical houses in the same street next door to each other. So the price, £200,000. So both of you buy identical new build houses for £200,000. Here's the difference, the funding. Now, basically, the first buyer has loads of cash and decides to put £200,000 in. Lucky them, they can just pay the asking price in cash. Another word for that is equity. You immediately have £200,000 of equity in the property because you've just bought it outright. It's yours. Now, buyer B, who's buying next door, in the same street, in the same suburb, isn't quite as well off. So he puts down a £100,000 deposit, not bad, 50%, can't argue with that, and then takes out a loan, or a mortgage as we call it, for the remaining £100,000. So of course, you've still got to find £200,000 to buy the property, it's just a question of how. And buyer B goes for a £100,000 deposit and a £100,000 loan. Now so far you might say, so what? They can both move in, they've both got the keys, they can both live there, with B repaying the mortgage over however long it takes. Is there a difference between these two from an investment point of view and a kind of return on investment point of view? Yes, there is. Let's take an extreme case in a bull market. Let's say the value of these properties quickly rises. So let's say even just a couple of years later, the value of the house in both cases, because they're identical houses, has rocketed up to 300,000. Now imagine, ignoring transaction costs, estate agents and all that kind of malarkey for this example, now imagine both sellers, or both buyers, decide to sell. They can't stand living next door to each other, so they both dump their properties at the same time. Now, over here, you pay £200,000 for a house, you're selling it for £300,000. Easy maths. Basically, you have made yourself a profit of £100,000. So, over here, nice little profit of £100,000 ignoring transaction costs. In other words, you've turned £200,000 that was invested in a house into £300,000 by selling it. Over here, what's the situation? House is worth 300, so let's sell it. Let's assume we're still carrying a loan, a mortgage on it of £100,000. Okay, so basically, you sell the house, you repay the loan of £100,000, so the difference between the value of the property and the value of the loan is £200,000. Now, point is this. Over here, this is the better strategy. This is leveraged investing in property, and the result is this. Having put £100,000 in, you're taking £200,000 out. Over here, having put £200,000 in, you're taking £300,000 out. And in percentage profit terms, this is the better return on investment. Turning 100,000 into 200,000, or doubling your money, is better than adding 100,000 to 200,000, or adding 50%. And that's purely a function of leverage or debt. So mortgages can actually increase the rate at which you make money in a bull market. And you might be thinking, well, in that case, the next time I buy a house, I'll gear myself up to the eyeballs. I'll go for a 95% mortgage. Two problems with that. Number one, you probably can't get one because the banks aren't lending like that at the moment. But more fundamentally, even if they were, you wouldn't want to do it. And that's because, in reverse, leverage is a nightmare. Okay, what do I mean by that? Well, let's just maybe skip back quickly to these numbers. And let's say the original property, rather than going up in value, plummets. Okay, so we'll keep the facts as they were at the start of the example. So what do I mean by that? What I mean is we started off with a £200,000 house, funded 100% with cash here and 50% with debt over here. But now let's imagine that a year later the price of the property hasn't increased, it's dropped. Let's imagine we're in a bear market. Well, we don't have to imagine that, we are in the UK. Let's imagine that the value of the house you're living in plummets to £100,000. And right now, this is the more likely scenario, you might say. Okay, so you've really had a nightmare. These buyers have bought in the wrong suburb and basically prices have collapsed and they hate each other, so they still want to sell. All right, now try selling now, assuming you can find anyone to buy the house. Okay, basically position is this. Buyer A sells the house for £100,000. That unfortunately has wiped out 50% of the cash they had in the property. Because don't remember, they owned the whole property, so they'll get the selling price back in cash. That's still half what they put in. That's like if you buy an asset for 200, it goes down to 100, you lose half your money. Over here, that's bad, but over here, basically, poor old buyer B's got a much bigger problem. Sell the house for 100,000, you've got to pay the mortgage off, all right? You can't just leave the bank loan outstanding for 100 grand. Clearing the loan reduces this to zero. In other words, all you can do is clear the loan. Your £100,000 deposit is gone. That's 100% of your initial investment. So that's an illustration of what gearing can do on the flip side. Get it wrong and it wipes out your money a lot quicker. Now, property was investment number one. Investment number two we can do very quickly. Investment trust companies. At Money Week, we like them. I've done a video on why we like investment trusts, so I'm not going to explain the whole concept here. But in essence, when you hear us talking about why we like investment trusts as investment vehicles, that's companies that buy shares in other companies, rather than unit trusts, which are sort of a big part of the industry called mutuals in the States and often advertised and marketed hard, one of the answers is gearing. Investment trusts are able to borrow. In other words, I could do a very similar example like this, where buyer B is an investment trust and buyer A is a unit trust, if you like, and you get a similar conclusion. The ability to gear up, which investment trust companies have, can accentuate returns if the directors get it right. Word of caution would always be using a sort of Morningstar or a TrustNet website, for example. Check the level of gearing, it's called gearing often, in an investment trust company before buying, just to make sure it's not suicidally high. Because if it's really high, you do risk, if the market falls, a scenario like buyer B for property. Okay, so basically what we're saying is property investment can be enhanced with leverage, but you want to be careful right now. Investment trusts can use leverage to their advantage, but always check how much they're using. And the third area where leverage plays right into your hands but can also be catastrophic is spread betting. So let's take a quick look at my third investment that uses leverage, spread betting. And why not pick a topic that's all over the newspapers at the moment, the gold price. Gold's gone crazy. Basically, we have plenty of Money morning emails at Money Week which explain Dominic Frisby what's going on there and what you should do, but one option would be a spread bet. I'm just going to use that to illustrate leverage. That's all I'm going to do this morning. I'm not going to say buy or sell, just how the leverage side of things would work. Okay, so a gold spread bet might look something like this as my third investment. I'm going to keep the numbers very simple here. I'm going to ignore bid to offer spreads just to give you the basic flavour as to why spread betting can be fantastic or can be a bit of a disaster. It depends on how you use the fact it's leveraged. Leverage being you get a lot of bang for your buck. That's what it really means. So take a very quick example. Let's say you could buy gold using a spread bet at, I'm going to create a price here of, let's say 1,580. Now the gold price recently broke $1,600 per ounce, it's just over £1,000. So let's say the spread bet price you're being offered is 1,580. So you open a spread betting position, $1,580. Now, in reality, it might be 1,580.3 or 0.7, okay? But let's say it's 1,580 dead, and you open your position. The gold price rises, let's say, and gets back to $1,600 an ounce. By the way, for anyone who thinks this is a little quick, I have made two other videos, one on what spread betting is all about and another one on why you should do it. So have a look at those if you're getting lost. But let's say the gold price rises to $1,600 and I decide to close my position by selling out of it at the new higher price. So my profit, and again it could be 1,600.7 or 0.75, but let's say it's 1,600 dead. So in profit terms you'd think, well, that's the difference between $1,600 and 1,580. So that's a $20 profit. Well, this is the point about spread betting. Okay, this would be the profit you make off an ounce of gold. That's not how spread betting works. Spread betting gives you exposure to a lot more. And that's because with a gold spread bet, you're actually betting per 0.1 dollar movement in the gold price. So what that means in effect is, yeah, there's a $20 profit here, but expressed as a number of 0.1s of a dollar or tenths of a dollar, if you want to see it that way. That's a 200 point profit. To a spread better as a 200 point profit. And if I was betting at say £10 per point, that would give me a £2,000 sterling profit off a very small upfront deposit. My broker might only charge me a percentage of my total exposure and I've made a £2,000 profit. So off a $20 move in the gold price, a spread better could make quite a serious profit or loss if the price drops. So advice for spread bettors, put in stop losses and talk to your broker if you're not sure what those are, or see my video on spread betting.
Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And today we've got a really cool video for you that I think you're really going to love because it shows you how to buy stock at basically a fourth of the price and capital requirement that it would cost to traditionally just go long stock. And that's using synthetic long stock with options. And again, do you guys even know that you can still have the same risk reward features of owning the stock without actually owning the underlying stock? Now, since we know that owning and holding long stock is so capital intensive, today we'll show you how you can use options as a way to synthetically go long with 1/4 the capital requirement. So this is how we're going to set up this strategy with options. First, we're going to buy an at-the-money call option because we're going to go long the stock. And then at the same time, we're going to go across the option chain and sell one at-the-money put option at the exact same strike price. So buying a call at the same strike as we sell a put option, all again the same strike price. So what's the risk in this position? Well, just as with the traditional long stock position, you do have unlimited risk should the stock continue to fall into expiration. Again, we're trying to replicate a stock position. So in that case, we do have unlimited risk that the stock does continue to fall. As far as profit potential, because you are emulating a long stock position, again, you have unlimited profit potential up until the expiration of the options you traded. Now, this is the only caveat to this strategy, is that we can replicate almost everything with a stock position except for the fact that stock you can hold much longer, and with options you do have a defined expiration date. But this is also a great strategy if you want to pinpoint or target some long stock positions or short stock positions into different types or times of the year. So how do you calculate the break-even points? Well, on these, it's very simple. It's your long strike price plus or minus any debit or credit that you receive on the trade. Usually you'll pay a net debit to enter the trade, but in some cases, if the options are trading just a little bit higher than where your strikes are, you might end up with a credit, in which case you would take that long strike and subtract out the credit that you paid. So let's go to our broker platform here on thinkorswim, and we'll take a look at an example. So GE is a very popular stock for people to own. I know a lot of people own in their portfolio, and just judging by today's volume, almost 37 million contracts that were traded, I'd say it's probably still a very popular stock to trade. So it closed the day just above 204. So if we wanted to go long this stock and go long it with 100 shares, we could go ahead and buy 100 shares of GE at 204, or I'm sorry, at 2404. And if we did that, our capital requirement on this trade to go long, oh, that's just 10 shares. Our capital requirement to go long this trade of 100 shares would be about $2,409. So you can see that's the cost to get into this trade. $2,409 to get into this trade. That's a lot of money to throw into just one stock and one trade. Now what we can do with options is we can replicate that position by, again, using an at-the-money call strike and selling an at-the-money put strike. So in this case, we will use the 24 strikes, which are right here. Those are the closest strikes to where the stock is currently trading at 2404. We're going to buy the call option, and then we're going to go ahead and sell the corresponding put option at the exact same strike price. So you see in this case, because our strike price is just a little bit lower than where the stock is trading, we do receive a small credit of 10 cents or $10. But the key here is that we're trading the exact same strike prices on both sides, going long the call option and short the put option. Now this gives us the exact same profit loss diagram as we would have if we just had the long stock. So you can see it's exactly the same, just one upward trending line. Now the key here is that when we go ahead and try to confirm this order, you can see that the cost to get into this trade is just about $7 to get into this trade because we receive a credit. But what our broker really covers in margin is about $544. So even though we do receive a credit to get in this trade, I don't consider that to be the investment. I consider our investment to be what the broker is holding in margin, which is $544. Now when we compare this to the $2,400 that it costs to actually own the stock below, you can see why it costs almost 1/4 to go synthetically long GE as it does to just buy the stock outright. So using options, we're able to get into and mimic the same risk reward features of a stock position, but with 1/4 of the capital required to make the trade. Now, some of the key takeaways from going synthetic long a stock. These are great alternatives to buying the stock outright, like we said, because they require such a low capital investment. But again, don't let these smaller initial investments blind you to the massive risk that you're taking with this strategy. By no means does the fact that you're investing upfront a smaller amount of capital mean that you have smaller overall risk. You still are mimicking a stock position. So if tomorrow the company goes bankrupt and goes all the way to zero, you do carry that risk through the trade. And I think that that's an important point to close out this video with. As always, again, if you guys have any comments or questions, please ask them right below in the comment section on the lesson page. And until next time, happy trading.